Hello, and welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called Directional Majority Pullback. This is a trend continuation strategy with an unusual heart. Instead of a moving average or a momentum reading, its regime filter is a genuine statistical hypothesis test called the sign test, applied to the color of each candle. By the end of this video, you'll understand how it measures a real directional bias, how it waits for a shallow pullback before joining the trend, and how it manages risk. Remember, this is for educational purposes only and not financial advice. So what exactly does directional majority pullback do? At its core, this expert advisor is a trend continuation system. It tries to identify when a market has a genuine, measurable directional bias, and then it looks to join that bias on a shallow pullback rather than chasing an extended move. What makes it distinctive is the tool it uses to define the trend. Most trend filters, moving averages, momentum, slope, and the like, react to the magnitude of price moves, which means a single oversized candle can distort them and cause whipsaws. This strategy throws magnitude away entirely. It asks a purely categorical question using a classical statistical test called the one-sample sign test. Over the last 20 candles by default, it counts how many closed bullish and how many closed bearish, discarding any flat doji candles. It then computes a z-score that measures whether that majority is larger than random, 50-50 chance could reasonably explain. Because only the color of each candle counts, one giant spike bar is weighted exactly the same as a tiny one, so the regime reading stays robust to volatility shocks. Once a statistically significant majority is confirmed, and price is on the correct side of a baseline moving average, the strategy waits patiently for a shallow countercolor pullback and then a resumption of the trend before entering. In terms of markets, nothing about the symbol or time frame is hard-coded. It was built with liquid, trending instruments in mind. Think major currency pairs, gold, or an index, on time frames around 15 minutes to 1 hour, but you can study it on whatever you select. It's designed to appeal to traders who like a rules-based, statistically grounded approach to trend following, with a strong emphasis on disciplined, structured risk management. Again, everything here is educational information only and not financial advice. Let's walk through the mechanics step by step. Everything is evaluated on completed candles on a single time frame. First, the regime filter. On each new bar, the strategy looks back over the last 20 candles and counts the bullish closes and the bearish closes. Call those up and down. It computes the z-score as up minus down, divided by the square root of the total number of decisive candles. This is the sign test. If that z-score is greater than or equal to the majority threshold of 1.5, and the last close is above the baseline exponential moving average, the strategy declares a significant bullish, or up, regime. If the z-score is less than or equal to negative 1.5 and the last close is below the moving average, it declares a bearish or down regime. Next comes the two-stage entry. In an up regime, the strategy waits for a single countercolor candle, a bearish candle, which represents a shallow dip inside the uptrend. This arms the setup. It then starts a countdown of up to 5 bars, the ArmMaxBars parameter. If, within that window, a bullish candle closes back above the previous bar's high, that reclaim confirms the trend is resuming, and the strategy signals a long entry. For shorts, everything mirrors. A bullish rally candle arms the setup, and a bearish candle closing below the previous bar's low confirms the short. Importantly, if the regime disappears before the trigger, the pending arm is dropped immediately. It never carries across a flip. Now risk management, which is engineered around a modest drawdown target. When a trade is taken, the stop loss is placed just beyond the structural swing extreme of the pullback leg, scanned over the last 4 bars, and padded by half the average true range. If the resulting risk is wider than 3 times the average true range, the setup is skipped entirely, so no outsized trades are taken. The take profit is set at a reward-to-risk multiple of 2. Finally, the trade is actively managed. Once price moves 1 full risk multiple in favor, the stop is pulled to break even and then trailed by 1.5 times the average true range, and it is never loosened. Only one position is held at a time per magic number, so there is no pyramiding. Together, these rules aim to keep individual losses small and controlled. Here's the heart of the MQL5 code as you'd see it in Meta Editor. At the top are the inputs. Majority lookback, defaulting to 20, is the window of candles the sign test covers. MajorityZ, at 1.5, is the minimum z-score needed to call a bias statistically real. Trend EMA period is the 50-period baseline used as a side of price check. ArmMaxBars, at 5, is how long a dip arm stays valid. Stop ATR multiple, max risk ATR, and reward risk govern the stop padding, the maximum allowed risk, and the 2-to-1 target. Below that you can see the sign test itself. The z-score is up minus down, divided by the square root of the effective count. The bull regime is true when that z-score is at or above the threshold, and the last close is above the moving average. The bear regime is the exact mirror. Then the two signal blocks. In the buy block, when the setup is armed long, the code checks for a reclaim, the last candle closing bullish and above the previous bar's high. If that's true and there's no open position, it calls try-enter for a long. In the sell block, when armed short, it checks for the last candle closing bearish and below the previous bar's low and calls try-enter for a short. Finally, inside try-enter, risk is the distance from the entry price to the stop. The take profit is the entry plus reward risk times that risk for a long, or minus it for a short. Then the order goes in with trade.buy or trade.sell, each carrying the calculated stop loss and take profit. That's the full round trip, from statistic to order. Let's bring the whole idea together on this illustrated chart. Along the bottom, you can see the strategy's real engine, the sign test z-score, plotted as its own oscillator, with a green band marking a statistically significant bullish majority above positive 1.5, and a red band marking a significant bearish majority below negative 1.5. Riding on the price candles themselves is the baseline exponential moving average, the 50-period line the strategy uses only as a which side of price check. Watch the opening sequence. The first several candles close higher one after another, a steady run of bullish bodies. As those closes accumulate, the z-score in the lower panel climbs and pushes up through the positive 1.5 level into the green zone. That crossing is the important moment. It tells the strategy that the recent candle majority is larger than a fair coin, 50-50 split, could reasonably explain. At the same time, price is trading comfortably above the moving average, so the up regime is now confirmed. Notice that the strategy does not buy here, at the top of an extended run. Instead, it waits. On the next candle, a single bearish body prints, a shallow dip inside the uptrend. This is the arm stage. The strategy notes the counter-color candle and starts a countdown of up to 5 bars, watching for the trend to resume. The resumption arrives on the following candle. A bullish candle forms and closes back above the previous bar's high, reclaiming the ground the dip gave up. That reclaim is the buy signal, and you can see the buy entry marker placed right there. Because the entry is taken on a pullback that resumes, rather than at the extreme, the strategy is joining the trend at a more considered spot. The stop loss is tucked just below the swing low of the pullback leg, padded by half of the average true range, so a little normal noise won't clip it. The take profit sits at a reward to risk multiple of 2, twice the distance from entry to stop. From the entry, the next 2 candles push higher, price advances into the take profit target, and the long trade is complete. Along the way, once price moved 1 risk multiple onside, the stop was pulled up to break even and then trailed by 1.5 times the average true range, protecting the position. Now watch the character of the market change. A run of bearish candles takes over. Price slides back through the moving average and closes below it. And in the lower panel, the z-score falls all the way through the negative 1.5 level into the red zone. A statistically significant bearish majority is now in force, and price is below the baseline, so the down regime is confirmed. The mirror image setup unfolds. A single bullish candle prints against the downtrend, a shallow rally. That arm's a short. On the next candle, a bearish body closes below the previous bar's low, breaking down and signaling that the downtrend has resumed. There's the sell entry marker. For the short, the stop loss is placed just above the swing high of the little rally, again padded by the average true range, and the take profit is set the same reward to risk multiple of 2 below the entry. The final candle extends the decline. Price reaches the take profit target, and the short trade closes. So across both trades, the pattern is identical, just flipped. A statistically real directional majority, a shallow countercolor pullback to arm the setup, a reclaim or break to confirm resumption, and then a structured stop and target with a break-even and trailing routine handling the risk. Only the sign of each candle drives the regime read, which is exactly what makes it resilient to a single oversized spike bar. And that brings us to the end of our look at directional majority pullback. We covered how it uses the statistical sign test on candle color to define a genuine directional majority, how the two-stage arm and reclaim lets it join a trend on a shallow pullback instead of chasing, and how its structural stop, reward to risk target, and break-even trail handle risk. Remember, everything in this video is educational content only and not financial advice. Trading involves real risk, and losses do occur. If you found this analysis helpful, please like the video, leave a comment with the strategy you'd like me to break down next, and subscribe for more MetaTrader 5 strategy analyses. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.